Gold is not an inflation hedge. There's so much inflation out there. Why isn't gold at 3,000, or why has it had a very poor Q1 to 2021? The answer is that gold is not an inflation hedge. When you see higher inflation, it doesn't mean that gold is going to rise. What you want in order to get a bull market for gold, and you can look at it for the past 50 years and plot it against each other, is you want real interest rates to go down. And real interest rates is basically the subtraction between how much the 10-year treasury bond yields and how much inflation is out there. So if the 10-year bond right now yields 1.6% and inflation, meaning the CPI, is at 2.6%, then you have a situation where real interest rates are minus 1%, because that's 1.6 minus 2.6. Whenever there's negative real interest rates in the economy, gold is much more relevant than cash, because you're literally losing money holding cash. Okay? So the more this trend goes negative, the better for gold. And what happened in Q1 of 2021? Well, CPI didn't change that much. The expectation of inflation was definitely out there in the economy everywhere. People were like, oh my God, there's inflation everywhere. But in real terms, nothing came out that says inflation is higher on the CPI. What happened in the meantime was bond traders started to rally yields up, and yields have gone up and up and up. And so negative interest rates became all of a sudden much closer to zero. Very bad for gold. And so you saw this dual reality where inflation was all around us, reported as, man, lumber prices, real estate prices, copper prices, etc. But gold wasn't moving. And the flip side is happening right now. Bond traders are saying, well, maybe inflation isn't so bad. And so yields are coming down, and that actually makes gold more valuable. So what you're going to see in the next few days and next few weeks and months is that will come into some sort of an equilibrium. And I think that gold has a really good chance of breaking above 2,000 again, because you will see CPI going up, but the bond move is very much exhausted.
Now, let me ask you, you said in the next few months you think gold will probably break 2,000. For silver, 3650, where do you see, or when do you see that number possibly happening? I mean, I know it's hard. I mean, nobody has a crystal
there is
ball,
no,
but
yeah. Even with gold, it doesn't matter. The timing of certain price targets is irrelevant. The catalyst is everything. So instead of trying to think when will silver be at 36.5, why don't you just look at 29.5 as the sort of the launch pad, and you know that the risk of trading silver is statistically much lower once you pass that resistance point. That's one thing. And secondly, look at the DXY and see a real breakdown in the price of in the relative price of the dollar, and that diminishes the risk of getting into a trade on silver, because you already see confirmation of a weaker dollar. So that's for silver. For gold, here are the catalysts. Okay, you have middle of the month, you have an FOMC meeting, meaning that the Federal Reserve is going to say what it thinks about inflation and what it thinks about tightening. What I think Jerome Powell will say is something to the effect of, there is inflation. We think it's healthy inflation. We're not going to do anything because of this inflation. And if he says that, then what he means is inflation is under control. If inflation is under control, there's no reason to rush to bonds. So bond deals won't necessarily go up, and CPI numbers will continue to trickle up. So I think that is really good for gold. The more you see negative rates becoming even more negative, the better for gold. And so I think the environment in the next few months is going to get more negative. And that's why I'm saying that you can see a 1 to 2 to 3% move in gold easily, and even a 4 to 5% move in gold. And obviously, every 1% is about $20. So to see a 4 to 5% move is definitely taking us to around that $2,000 area.
So now let me ask you this too, because you were talking about it earlier, saying, people who are buying silver and gold to stack, we want those prices to be low. We want those prices to drop. And I'm always saying that, like, sometimes there'll be some people within the stacking community posting pictures of, the silver and gold spot prices like shooting upwards, and they're saying, all right, let's go. And I'm like, no, I want it to drop. I'm young yet. I want to buy more of it. I don't want to have to pay more. Are you of that mindset too? Do you want the prices to come down so you could get more of it, or do you want to see it take off and just see your silver and gold positions just skyrocket in value?
So it's a dual reality, right? It's double standard, as I always put it, because on the one hand, you want it as low as possible because you want to stack it.
Right.
On the other hand, you do want to see the price increasing because it increases your net worth. So there's always that dual reality. And that's why I say that I put on two hats. One is the stacking hat. And with that, what I want is not prices to drop. What I want is for prices to be to rise moderately, so that when wages come in, when business income comes in, etc., I can buy more at sensible prices, right? I don't want the price to drop 50%. That doesn't help me unless I'm gonna make one big purchase. But usually people they just dollar cost average for the rest of their lives. So what you want is just moderately higher prices on that hat. On the other hat, when you buy a piece of a mining company, the idea is to buy it at a trough, right, so at a lower price, and to sell it higher. These are not buy and holds. If you plot a chart of Barrick Gold or Newmont or any of these giants for the past 30 years, they look like this. They never break out. What you want to do is you want to catch them when the sentiment is really bad and people think that gold is irrelevant, a barbaric relic. We have Bitcoin. Why we need gold? Yeah. All that bullshit that plays out, all that noise that people sell off gold and become impatient with it. That's when you want to get into that sector. And when you want to get out is when people are doing the opposite. When people are saying, gold is better than stocks. I don't need stock. The euphoria is there. Mm-hmm. That's what you basically want to see. And we don't see that right now. We definitely don't see euphoria anywhere regarding gold. This is not. It doesn't resemble 2011 at all. We did see a lot of euphoria in the summer, like July and August. I was like, it's going to be over very soon. July especially, right. You saw silver like just every day. Yeah, it was relentless. It was obviously the best month for silver since 1979, if I'm not mistaken. Yep. So that is what you don't want to see if you're a trader, or in other words, that's the time to take profits if you're a trader. If you're a stacker, it almost means nothing to you because you're almost like a landlord that owns a house, and the house is generating great returns from the rent. And you're like, man, my house is worth double what I paid for it, and 5 or 10 years ago. Should I sell it because it's double? No. If you're of the mindset that hey, the yield and the rent are so good, then you shouldn't do it. In other words, a stacker does not care about the price so much. He cares about the amount that he owns. That's what he wants. That bargaining power of owning a lot of precious metals if they get re-rated. And that's what we're all waiting for. That's the end game. Mm-hmm. That's the Basel III regulations. That's the ideas of how to change from a US dollar world to something else, because obviously the US dollar as a reserve currency is outdated. It's almost like a dysfunctional marriage, right? You see these couples that stay with each other because they're more afraid of the divorce than of the misery that they know, right? The devil that you know is better than the devil you don't know. And that's basically why countries use the dollar. It was good when the United States was not only the biggest economy in the world, but a creditor nation, country that lends money to other countries. Now it's the biggest borrower nation in the world. It's the biggest debtor nation, and it's just not the same world. The United States makes up 4% of the world's population. Think about it, just 4% of the world population, and in 2 to 3 years, it's not even going to be the biggest economy on the planet, GDP wise. So it's a very changing world, but the problem is it's very hard to replace it. It's very hard to replace it. So it's a dysfunctional marriage at this point. And that's why I'm saying it's a matter of time. And when that happens, it gets re-rated. Just think of what happened when Nixon took us off the gold standard. It went from 35 an ounce and started to discover its real worth until it got to 850 an ounce. Now, why did it stop there? What happened? Well, at 850 an ounce back in 1980, if you were to convert the official gold reserves at the Fort Knox from gold into fiat currency, in other words, if the United States were to sell everything or to put everything on a gold standard back again, you would have had 100% of the United States currency backed by gold at 850. So basically what happened between 1971 and 1980 is that gold got repriced to back the entire currency supply. If you want to do that today in the United States, gold will have to be about $33,000 an ounce to achieve the same thing.
Right.
Because it's covering around 5% of the currency supply. So you need the price to go up about 20 times. 1900 to, let's say, around 38,000. Some people say it covers 6% of the currency supply, and that's why I was using that more conservative amount that would basically indicate a 16-fold move in gold. If you want to cover the entire currency supply, and so look, you're in a situation in the world right now where they've in order to help with a healthcare crisis, central banks and governments papered over and created a lot of new currency. The reason is because everything works on credit, even if you have a healthcare crisis that had nothing to do with the currency system, nothing to do with the real economy. This is not like 2008 where you have the huge banking crisis, etc. The banks were fine a year ago, but because it's a credit system, everything froze. All the credit froze in that mid-March area. You remember when they opened markets and every 15 minutes there was a circuit breaker because people were selling everything. Right. Get me out of stocks, get me out of bonds. $30 trillion worth of assets were just sold. And when that is the system that you run on, credit, you have to paper over every type of crisis. That's the only way to do it. The analogy that I like to give is you can think about a Formula One car. It can go from 0 to 200 in 2 seconds, but it can also break from 200 to 0 in 2 seconds. That's what happens when you have a credit economy. It can fly because you're printing all this money and you create an artificial recovery or even a boom. But if you want to stop that thing, it can stop on a dime because it's so artificial. Mm-hmm. That's what you saw in March of 2020. And so when that went back to, you can race again when we reopened the economy, what happened was they charged that Formula car with more turbo, gave it all sorts of new improvements, meaning they papered it over, and man, that thing flies even faster. And so you're seeing all these imbalances, like what's happening with meme stocks and what's happening with altcoins. It's because people have so much currency, mm-hmm. They're just speculating with it, and it's going to end very badly. In gold and silver, it doesn't work that way. You get a set unit. You know what you get. You get an ounce. And so it's a big difference between these arbitrary assets like altcoins, where what do you own?
Right.
What do you own? What did you just pay $100 for?
Right.
What does it give you? In terms of, it's so different. It's a different world. And that's why I think it's indispensable to own gold and silver.
I couldn't agree with you more. And I do want to, you had mentioned it a few moments ago. Basel III. Can you talk to the audience a bit more about Basel III and its implications?
Absolutely. Absolutely. And in fact, we created a special download report just for your audience for this interview. If you browse to wealthresearchgroup.com/Basel, BASEL, you can download a full PDF report that goes through and explains everything and the catalyst and the potential of Basel III. The idea behind the Basel regulations is that, as you know, all commodities are also trading in paper markets, futures, ETFs, and just a lot of derivatives. So the amount of silver that gets traded every day on the LBMA and on the COMEX in London is far in excess of the real universe of physical precious metals. There's a big leverage on the paper markets because of the need for futures, etc. So what happens is banks like JP Morgan, Lloyd's, Barclays, what they used to do in the past 10 years until they got caught, and now they're much more careful about it, is they used to put like big sell orders or big buy orders, which they had no intention of actually fulfilling, but they scare other traders. If you want to buy silver and you see a huge multi-million-dollar position in the tens of millions or hundreds of millions from a big seller, you're scared to buy because you're saying, man, the price can really tank on me at any moment. And that's what they used to do. They used to spoof the market. And that obviously is price suppression, price manipulation, etc. And they had to pay $1 billion fine. That is, JP Morgan had to do it. And the Basel III regulations are looking to create a situation where it's going to be very hard to create those sorts of manipulations in the COMEX, because Basel III turns gold from a tier 3 asset to a tier 1 asset. Mm-hmm. What does that mean? It means that in the world right now of banking, there are only 2 tier 1 assets, the US dollar and US treasuries. When banks hold them, they get priced mark to market. In other words, they get priced at 100% of their worth. When you buy, for example, a piece of clothing, the second you wear it, it's immediately, it's not worth what you paid for it because now it's secondhand. Or when you buy a new car, immediately it drops. You haven't even ignited that thing.
Right.
The instant that you own it, a person owns it, it goes down. It's now worth less. And that's how most other assets are in the world. They're tier 2, tier 3, etc. Gold is a tier 3. In other words, when you buy gold as a bank, you only get to write the half of the amount as assets. And so a lot of banks would obviously rather own dollars or treasuries because they get the full amount. Well, now on June 28th, they changed that to a tier 1 asset. Tier 1 asset means, for one, that on June 28th, the banking system is basically telling you whatever the price is today, we believe it's basically worth twice. That's what they're telling you, right? Because they're telling you we're changing it from tier 3 to tier 1. Mm-hmm. What they're telling you is it's not worth this. It's worth double this. The real time frame to look at this is April 1st, 2019, when they actually announced that gold will become a tier 1 asset. This is June 28th is when it will come into effect. But April 1st, if you look at that date, if you actually go back to the gold price and look at April 1st, 2019, you will start seeing the breakout. It was $1,291 an ounce back then. And on Wealth Research Group, on our newsletter, we issued a special report on that day to the subscribers. And we said, look, today, the central banks of the world just told you gold is worth $2,584 an ounce, right? Because they just changed it from a tier 3 to tier 1. So that's how you should view gold as well. And on June 28th of this year, they're going to start implementing that on the bullion banks in London. And what people speculate will happen is that these banks will have less incentive to trade on these unallocated accounts and buy more of the physical supply. And as you can see, there are two markets. If you go on any bullion dealer in the United States right now, you will be paying a huge premium for physical compared to the spot price. And that's what basically the Basel III is trying to do. It's trying to create that, narrow that bridge, that gap between the physical market and the spot price, so that there's real price discovery out there. And, I've always said that if you look at silver from the industrial uses, which is half of the demand for silver, industrial uses, there are about 5,000 products out there that use silver. Well, how much silver is in our products, like a computer, like a cell phone? It's tiny amounts. So in other words, it's not like oil. If oil goes to $200 a barrel, it's a world that's hard to live in. It makes everything more expensive a lot. If silver goes to $50, your iPhone won't cost more. It just won't. The amounts are so tiny that Apple will bite that cost, and your laptop will not change. All these solar panels, they will not change in price because silver has gone from 30 to 50. It's not one of those situations where it's unsustainable. And so that's a lot of the argument against silver, that, hey, it's an industrial metal. We want it to be as cheap as possible so that our world is affordable. It doesn't matter, 30 or 50. It really doesn't matter for most of the industrial uses that it's in. It's very possible for silver to be at $50. It's not a big stretch of the imagination.
Right.
It's selling for $50 an ounce. And I want to remind you that it's one of the only assets, one of the only major commodities, one of the only 29 major commodities that has not surpassed its 1980 all-time high. In fact, it could be the only one. I have to just do a quick search, but for sure, it's one of the only two or three that have not made a major high and surpassed its 40-year record. So it's very cheap compared to its history.
Absolutely. I think, in full disclosure too, I was one of the individuals who would I was thinking, if silver skyrockets in price, that's going to make the affordability of a lot of the different products not unaffordable, but increase the price somewhat. But to your point, it does make sense that it's tiny, finite little bits and pieces that are in the everyday products that we're using, that it's not going to really make that big of a difference.
Can I share one?
Yeah.
When you're done. But
no, I'm done. Go ahead.
Okay. No, I don't want to disturb you or anything, but I just want to remember it. Just to give you an idea how cheap silver is. There are not many companies that go out there, raise money, and try to mine silver. Try to build a silver mine where the primary metal is silver. Because silver is so dirt cheap, it doesn't make sense economically to just go out there and look for silver. Silver is mined as a byproduct. When you have a gold mine, that rock, that ore, has some silver in it. And that's how you get a lot of your silver, from gold mines, from copper mines, from zinc mines, from lead mines. Pure silver mines are very rare because the price is so cheap. There is no economic incentive to actually go out there and build a company that just mines silver. Just to understand how cheap it is. Mm-hmm. That's a very rare situation. Most other commodities, you go out there, you try to explore for copper or for aluminum, etc. It's not the case with silver. Just to get perspective on it.
No, it's very important too. I don't think there's a lot of people that realize that silver is a byproduct. I've learned this just because of the various mining interviews that I have done with various companies. So that's something that I kind of picked up along the way, and I think that that's a very good point. I will be posting a link down below for everybody to check out the newsletter that Lior Gantz has available for all of you, which is an excellent resource. And Lior Gantz, CEO and founder of wealthresearchgroup.com, I truly appreciate your time today. And I do look forward to talking with you again real soon.
Thank you, sir.
And I would like to quickly thank these elite channel supporters. And if you haven't already become a channel member, please check out the awesome perks and join today. With that, this is Empire Precious Metals. Until next time, long live the Empire.